Okay, so we just had our first bank collapse in 2024. And in this video, we're going to talk about why you should care. All right, so let's talk about it.
I got a bad feeling about this.
This is the Hey Ed YouTube channel. I am your host, moderator, and all-around nice guy, Edward Anderson. And today I want to talk to you about a very important issue that a lot of people are not really aware of. It's not really being covered in the mainstream media. And that is we had our first big bank collapse here of the year. Okay, so this is about a regional bank called Republic First, not to be confused with First Republic, which went under last year, actually about 13 months ago. Remember when we had those spate of banks that went under last spring? Well, one of those banks was called First Republic. Well, this bank is called Republic First. Yeah, these bankers aren't really that clever, in naming their banks. So let's first talk about the news, and then we'll talk about how this happened and why this could be the start of something really big. The FDIC said Friday it had seized the Philadelphia-based bank, which did business as Republic Bank, and had roughly $6 billion in assets and $4 billion in deposits as of January 31. Fulton Bank agreed to assume substantially all of the bank's deposits and buy essentially all of its assets. Okay, so Fulton Bank is going to be taking over the assets of Republic First. Just like last year, JP Morgan took over the assets of First Republic and several other banks. Remember, this is part of the consolidation that's going on in the banking industry. And this is part of the Federal Reserve's playbook. They want to get rid of banks. They don't want so many banks out there. They want this to happen. They want to get the banking system down to 4 or 5 top banks. And this is part of the process. Now, this is the concerning part. The reason for this bank going under are the exact same reasons that the banks last year went under. And remember, that happened a year ago. So this bank had a whole year to fix their problem, and they didn't do it. And these issues are systemic. These are the same issues that all banks around the country are facing. One of the largest issues is commercial real estate. Rising interest rates and falling commercial real estate values, especially for office buildings grappling with surging vacancy rates following the pandemic, have heightened the financial risks for many regional and community banks. Outstanding loans backed by properties that have lost value make them a challenge to refinance. Okay, so this year, the banking industry was relying on the Federal Reserve cutting interest rates and giving them, a little respite from their problems. But the fact is, now it's looking like the Feds are not going to do that. They might even start raising interest rates again. Now, at the end of 2023, there was over $400 billion worth of commercial real estate loans outstanding. That is a huge issue, because what's going to happen more and more here is you're going to see these commercial loans, starting to default because people can't maintain the payment on those loans. So this problem is going to be exacerbated over the next 6 to 12 months. So you're going to see more and more banks fall under the weight of that issue alone. But on top of that, a more immediate issue are car loans. The car loan industry is a problem for the banks right now. You're seeing a lot of cars being repossessed because people cannot maintain their payments on their cars. If you bought, a car last year for $40,000, $50,000, and you cannot keep up with the payments, you hope the bank takes your car back because you don't want to make payments on a depreciating asset. You're underwater on the value of that car. That car that you bought for $40,000 today is probably worth about $22,000. So you're underwater on that, on that asset, but you're still making payments on that $40,000 loan. So you would prefer that the bank just repossesses your car and takes it off your hands. But the banks don't want your cars either because it's a depreciating asset. So I think what you're going to be seeing here in the immediate future, really it's going on right now, is you're going to see an increased repossessions of cars. Now here's another warning sign. So last month, we saw the biggest outflow of deposits from banks since September of 2001. And everyone knows what happened in September of 2001, particularly September 11, right? So people are pulling their money out of their banks in droves right now, which is what you should be doing. Are you? And another clue that we can look at is the decline in bank credit. Let's take a look at this chart. Okay, so this is a chart of bank credit since 2019. And it might not be that obvious in here. It looks like it's been flattening out there in the past couple of years, but really it's been declining. Now, just remember how banks make money, right? They issue loans, right? And they pay the depositors a pittance for keeping the money in the bank, and then they make money off of the interest rate that they're charging on their loans. That's what fractional reserve banking is. Well, banks now, as we can see, as per that chart, they're not giving out loans anymore. I mean, that's what that chart is referring to. Is referring to loans that banks are giving out. But banks see too much risk out there in giving out loans. I mean, in a healthy economy, you would see that chart continue to trend upward, but that's not what's going on. Now, someone yesterday in a Zoom call asked me what my opinion is about, when the next market collapse is going to take place. I could not give an exact answer, of course. I have no idea when the market is going to fall apart, but I think it has to happen. I think it's going to happen. What's going on in our economy is unsustainable. And the Fed is in a very precarious position. Okay, on the one hand, in order to stimulate market activity and the economy, they need to lower interest rates. But if they do that, that's going to trigger hyperinflation. But if they raise rates in order to fight inflation, because that's how you fight inflation, right? If they raise rates, that's going to lead to more defaults and more bankruptcies and potential economic Armageddon. So what I think is probably going to happen somewhere along the way here is there's going to be some kind of a catalyst that the Federal Reserve can blame for a sell-off. Oh, I didn't know that was going to happen. I didn't know that JP Morgan is going to go out of business. I didn't know that there's going to be a big default in the derivatives market. So what's going to happen is there'll be some kind of a black swan event, a surprise event. So the Federal Reserve and our government officials can blame that instead of themselves. Remember, politicians are never to blame, right? It's not my fault when it is exactly their fault. Okay, now it is true that in a regular, economy, 3 or 5 banks per year go out of business. That is true. Okay, but when you look at the underlying reasons why this Republic First Bank went out of business, those issues are systemic. They are throughout the banking industry. And there is a good chance that a day is going to come where you're going to wake up in the morning and you're going to see a collapse in the financial industry and in the banking industry, and you're going to run to your bank to get your money out of the bank, and you're not going to be able to. The doors are going to be locked, and they're not going to let you pull your money out. I mean, even right now, if you try to pull a substantial money out of your bank account, they're going to make you justify it. They're going to ask you literally, so what are you going to do with this money? The banks don't have your cash in the bank. You got to keep in mind that any money you have sitting in your bank is legally not considered your money. It's not safe. Now, I'm not saying you should get all your money out of your bank. I mean, you still need to pay bills and stuff, right? But I don't think you should have more than 2 or 3 months worth of bill paying in the bank. That's it. Everything else you should get out of the bank. But even when you get that money out of your bank, you're still sitting on a depreciating asset, courtesy of inflation. So take a bunch of that money and put it into gold and silver. That's how you protect your buying power. And then, of course, establish streams of passive recurring income. So get your money out of the bank, buy some gold and silver, and establish streams of passive recurring income. Ed Anderson, live from Minnesota, signing out.
Copy that.